Copper just did something that has never happened before, and almost no one is watching. Copper futures have smashed through every record on the books, topping $6.90 a pound in the United States, breaking above $14,000 per metric ton in London. Normally, when copper spikes like this, it means one thing: the global economy is booming, but this time is different. CNBC just issued a warning that changes everything. This isn't about growth, it's about a shortage, a structural decade-in-the-making shortage, driven by AI data centers, power grids, and a supply chain that simply cannot keep up. And if you own silver, or you're thinking about buying it, you need to understand this right now, because the exact same forces breaking the copper market are quietly setting silver up for one of the most explosive supply squeezes we've seen in years. Here's why. Welcome to Currency Arc Insight, where we turn today's economic warning signs into tomorrow's financial clarity. If this channel has helped you see the markets differently, do us a favor and hit that subscribe button. It costs nothing and keeps you ahead of the next major shift. And before we dive in, drop a comment and let us know where in the world you're watching from today. In the world of commodities, few events carry the weight of a genuine once-in-history price record. Copper has just delivered exactly that. Futures have shattered every previous ceiling, climbing past $6.90 a pound in the United States and breaking above $14,000 per metric ton on the London Metal Exchange. For a metal that has traded for centuries, this is not a minor technical milestone. It is a structural break from everything markets have come to expect. Traditionally, a copper rally sends a simple message to investors. Copper is often called the metal with a PhD in economics because its price tends to rise and fall with the health of global industry. When copper climbs, the assumption has always been that factories are humming, construction is expanding, and the broader economy is accelerating. That assumption is precisely what CNBC's recent reporting has called into question. According to the findings highlighted in that report, this breakout is not being driven by a booming global economy. Growth signals around the world remain mixed at best. Instead, the surge is being driven by something narrower and, in many ways, more concerning. A collision between explosive new technological demand and a supply chain that has no ability to respond quickly. Three findings stand out. The first is that demand for copper right now is unusually concentrated. Rather than reflecting broad-based manufacturing strength, the current surge is being pulled almost entirely by two forces: the build-out of artificial intelligence data centers and the modernization of power grids around the world. Analysts who track commodity data have pointed out that this narrow demand profile is itself a signal. When a metal spikes because of infrastructure build-out rather than general economic expansion, it points to a specific and sustained category of consumption, one that is not going to slow down simply because broader growth softens. The second finding centers on China. In the first half of this year alone, China increased its power grid spending by 13%, committing close to $574 billion toward electrical infrastructure upgrades. This is not a temporary stimulus measure. It represents a long-term national commitment to rebuilding and expanding the systems that move electricity across the country, and copper sits at the center of that effort. The third finding is perhaps the most important for understanding where this story goes next. Supply is not keeping pace, and the shortfall is becoming severe. Chile, the world's largest copper producer, has been hit by significant weather disruptions that have slowed output. The Democratic Republic of Congo, a major supplier of copper and cobalt concentrate, has moved to ban raw exports entirely in an effort to force processing to happen domestically rather than overseas. At the same time, uncertainty around potential trade measures in the United States, including possible Section 232 duties, has pushed buyers to pull copper out of London Metal Exchange warehouses at an accelerated pace, tightening available supply even further and driving refining costs sharply higher. Taken together, these three forces paint a picture that is fundamentally different from a typical commodity boom. This is not a market signaling that the world economy is firing on all cylinders. It is a market signaling that a specific set of technologies, from artificial intelligence to grid modernization to electrification, is consuming raw materials faster than the mining industry can supply them. That distinction matters enormously, and not just for copper investors. Because, as this report will show, the very same forces tightening the copper market are already reaching into a much smaller, much more overlooked corner of the metals world. A metal that shares copper's core physical properties. A metal that industry increasingly cannot do without. That metal is silver, and understanding its connection to what is happening in copper right now may prove to be one of the most important things a precious metals investor pays attention to this year. There's a natural assumption that markets make when any commodity price spikes. Higher prices should attract more supply. Miners see the opportunity, ramp up production, and eventually the market rebalances. It is a simple, intuitive idea, and it happens to be almost entirely wrong when it comes to copper and, by extension, silver. According to Bank of America's head of research, Michael Whitmer, building a brand new copper mine from the ground up takes upwards of 10 years. Not months, not a single fiscal year. A decade or more, from initial discovery to a fully operating mine capable of meaningful output. High prices today cannot manufacture new supply tomorrow, no matter how attractive the economics look on paper. The reasons for this lag are structural, not incidental. Before a single ounce of ore can be extracted, a prospective mine has to pass through years of permitting. Environmental review alone can take years, particularly for large-scale operations that affect water systems, local ecosystems, and surrounding communities. Regulatory approval, often spanning multiple government agencies, adds further delay. Even once permits are secured, mining companies face declining ore grades at many existing sites, meaning more rock has to be processed to extract the same amount of metal, driving up both cost and time. Layer on top of that the sheer scale of capital expenditure required, often running into the billions of dollars for a single major project, and it becomes clear why supply simply cannot respond to price signals the way textbook economics suggests it should. This is where the copper story becomes inseparable from the silver story, and it is a connection that most investors overlook entirely. Most people assume that when silver prices rise, miners simply dig more silver out of the ground to meet demand. The reality is far more constrained. Over 70% of the world's silver production is not the product of dedicated silver mining at all. It is a byproduct, extracted alongside copper, lead, and zinc during the mining of those primary metals. Less than 30% of global silver supply comes from primary silver mines built specifically to produce silver as the main product. This byproduct relationship means that silver supply is trapped inside the exact same bottlenecks currently constraining copper. When the Democratic Republic of Congo bans raw concentrate exports to force domestic processing, it does not just reduce the flow of copper into world markets. It simultaneously reduces the byproduct silver that would have come out of that same ore. When Chilean copper operations face weather-related shutdowns, silver output tied to those operations slows in lockstep, entirely independent of what silver prices are doing on their own. The connection is not theoretical, it is mechanical, embedded directly in how these metals are extracted from the earth. This is a critical distinction for anyone thinking about silver's supply picture going forward. A silver-specific price rally does very little to solve this problem because the majority of silver supply is not responsive to silver's price at all. It is responsive to copper, lead, and zinc economics, and to the same decade-long development timelines that are currently constraining copper output. That means the kind of rapid supply response investors might expect during a typical bull market is structurally unlikely to materialize here, regardless of how high prices climb in the near term. What this points to is a market entering a period where industrial silver demand, driven by solar, artificial intelligence infrastructure, and electric vehicles, is reaching record levels, while the physical mechanism for expanding supply remains locked behind the same 10 to 15-year development timelines constraining copper. Two metals, bound together not by speculation but by geology and the physical reality of how they come out of the ground. Understanding that link is essential to understanding what may come next, and that connection runs deeper than supply chains alone. It extends into the physical properties that make silver indispensable to the very technologies now driving copper's historic breakout. To understand why silver is so tightly bound to copper's fortunes, it helps to look past economics for a moment and into physics. Copper has long served as the backbone of global power infrastructure, from transmission lines to heavy transformers, largely because it strikes an efficient balance between abundance, cost, and conductivity. It is good enough and cheap enough to build entire electrical grids around. But copper is not the most conductive metal available. Silver holds that distinction outright. It is the single most electrically and thermally conductive metal on the periodic table, surpassing copper in both categories. For most of industrial history, that fact mattered less than it does today, because copper's lower cost made it the practical choice for large-scale infrastructure. As the demands placed on modern electronics intensify, that calculation is shifting in silver's favor for an increasing range of applications. Artificial intelligence infrastructure is at the center of that shift. As AI systems scale, the chips powering them run hotter and require increasingly dense power distribution to function reliably. This is not a market where engineers can simply substitute a cheaper material and accept a performance penalty. High-performance data centers depend on advanced microprocessors, high-speed printed circuit boards, and power management systems that require substantial amounts of silver working alongside copper. Where copper carries the bulk of the current, silver is often what makes the precision and efficiency of that system possible at all. There is a physical nuance worth understanding here as well. Silver and copper are not interchangeable in weight, even when they appear similar in form. Silver is measured in troy ounces, the standard used across precious metals markets, while copper bullion is typically measured in avoirdupois ounces, the standard everyday ounce used for most commercial goods. A 1 troy ounce silver round and a 1 ounce copper round may share the same diameter and thickness, yet the silver piece will weigh more because a troy ounce is heavier than an avoirdupois ounce. It is a small distinction, but one that speaks to how differently these two metals are treated even at the physical, weighed-out level, despite how closely their industrial fates are now becoming linked. Artificial intelligence is not the only force pulling silver into this story. The transition toward clean energy technology is consuming both metals at a pace few anticipated. Modern N-type TOPCon solar cells, now the industry standard for new installations, use significantly more silver paste per watt of output than the older cell technologies they are replacing. While some efficiency gains have allowed thrifting on older, less advanced cell designs, the newer and more widely adopted technology is doing the opposite, increasing silver intensity per unit of solar capacity installed. The electric vehicle sector tells a similar story. A single electric vehicle can contain up to twice as much copper and silver as a standard gasoline-powered vehicle, reflecting the far more complex electrical systems required to run and charge an EV. Hybrid vehicles, which combine a traditional combustion engine with electric components, also require more of both metals than a purely gasoline-powered car. And hybrid adoption has continued to expand rapidly across major auto manufacturers. When copper prices surge because of grid expansion and AI infrastructure demand, it is not an isolated event confined to a single commodity. It is evidence that a broader industrial electrification supercycle is underway, one that pulls silver along in its wake by physical necessity rather than by investor sentiment. Silver's conductivity, its role in solar, its presence in every electric and hybrid vehicle rolling off the assembly line, all of it ties silver's industrial fate directly to the same forces currently breaking copper records. This is the mechanism that connects copper's historic breakout to silver's future. But conductivity alone does not explain why supply cannot simply expand to meet this rising demand. That question leads directly into how silver actually enters the market in the first place. A supply chain far more fragile and far more dependent on copper than most investors realize. The connection between copper and silver is not simply a matter of shared industrial demand. It runs directly through the mechanics of how these metals are pulled from the earth. And that mechanical link is what turns copper's supply crisis into silver's supply crisis as well. As established, over 70% of the world's silver output does not originate from dedicated silver mines. It comes as a byproduct of mining operations focused primarily on copper, lead, and zinc. This means silver's availability on global markets is not determined mainly by silver's own price or by silver-specific mining decisions. It is determined by the operational status of base metal mines that happen to produce silver as a secondary output. And when those operations slow, silver slows with them, regardless of how much demand exists for silver on its own. This is precisely why the disruptions currently affecting copper carry direct consequences for silver supply. When the Democratic Republic of Congo moves to ban raw copper and cobalt concentrate exports in order to force domestic processing, the immediate effect is a reduction in copper reaching international markets. But the secondary effect is just as significant. The silver embedded in that same ore, extracted as a byproduct of the copper mining process, is restricted from reaching the market at the same time. One policy decision, aimed entirely at copper, quietly tightens silver supply as a direct consequence. The same pattern holds true for weather-related disruptions in Chile, the world's largest copper-producing nation. When operations there slow due to severe weather, it is not only copper output that declines. The silver that would have been recovered as a byproduct of that same mining activity declines in parallel. These are not two separate supply stories playing out independently. They are a single supply chain, interrupted at its source, with consequences that ripple through both metals simultaneously. As detailed earlier, this bottleneck cannot be resolved quickly. Opening a new primary copper or base metal mine takes 10 to 15 years. Once permitting timelines, environmental review, declining ore grades, and capital costs are accounted for. That means any current disruption to base metal mining does not represent a temporary dip that resolves itself within a few quarters. It represents a structural constraint that is likely to persist for years, regardless of how prices move in the interim. Meanwhile, demand on the other side of this equation is accelerating, not slowing. Industrial silver demand from solar manufacturing, artificial intelligence infrastructure, and electric vehicle production is reaching record levels this year, building on already elevated demand from the year prior. At the same time, physical silver inventories held on major exchanges, including COMEX in New York and the London Bullion Market Association vaults, have been steadily drawn down. Stockpiles that once served as a buffer against short-term supply disruptions are shrinking at precisely the moment those disruptions are becoming more frequent and more severe. Put simply, a copper supply crunch does not stay contained to copper. If current conditions continue along their present trajectory, a copper supply crunch effectively guarantees a silver supply crunch as well, not through speculation or market sentiment, but through the direct physical mechanics of how the two metals are mined together. Rising industrial demand is meeting a supply mechanism that cannot expand on any meaningful timeline, while the inventories that once provided a cushion continue to thin. This is the structural reality sitting beneath the headlines about copper's historic price breakout. It is easy to view copper's record run as an isolated commodity story, interesting but separate from the precious metals market. The evidence suggests otherwise. The same forces tightening copper supply are tightening silver supply in parallel through a mechanism most investors never think to examine. Understanding that reality raises an important question. If history is any guide, what tends to happen to a metal when its supply chain tightens this severely while demand continues to climb? That pattern, and what it may mean for silver stackers watching this unfold, is where this story turns next. Markets rarely move in perfect unison, even when two assets are structurally connected the way copper and silver now are. Historically, when base metals like copper break out into genuine all-time highs, silver is often lagged behind for a period of time before making a sharp, sometimes explosive, catch-up move. This is not a guarantee written into the laws of economics, but it is a pattern that has repeated across previous cycles, and it is worth understanding rather than dismissing. Part of what drives this lag then catch-up dynamic is investor psychology itself. As copper's historic breakout becomes more widely reported and understood, some market participants begin connecting the same dots being laid out here, recognizing that silver's fundamentals are tied directly to what is happening in base metals. That recognition has, in past cycles, been enough to draw speculative interest into silver well after the underlying structural case was already in place. In previous supercycles, silver has not simply tracked copper's move, it has outperformed it on a percentage basis once broader retail attention arrived and momentum took hold. That possibility deserves a note of caution rather than excitement. Chasing a metal because a speculative wave might be forming is a fundamentally different decision than recognizing a structural supply and demand imbalance. Investors should be wary of acting purely on the expectation that a speculative rally will repeat itself, since timing that kind of momentum is notoriously difficult even for professionals. The structural case laid out across this analysis stands on its own, independent of whether a speculative surge ever materializes. With that distinction in mind, 3 takeaways stand out for anyone tracking silver's position in this environment. First, the demand driving this story is structural, not speculative. Consumption tied to artificial intelligence infrastructure, grid modernization, and electrification is not dependent on market sentiment. It reflects physical build-out that is already underway and unlikely to reverse. Second, supply cannot flex quickly enough to meet that demand. Mine development timelines, stretching 10 to 15 years, mean that today's constraints are likely to persist for years to come, not months. Third, silver occupies a genuinely unique position among precious metals. It carries the industrial tailwinds now driving copper's historic breakout, while retaining the monetary characteristics that have defined precious metals for centuries. Few assets combine both forces at once. As this story continues to develop, close attention should be paid to physical inventory levels on exchanges in both London and New York in the weeks ahead, as continued drawdowns would reinforce the supply pressure already building beneath the surface. What began as a copper story is, on closer examination, a silver story as well, one built not on speculation, but on the physical reality of how these two metals are mined, consumed, and brought to market together.